Okay, so now we're going to go and answer the question, okay, as if we're writing the exam. I'm just doing it in Excel, but it's basically a response to an email. Okay, so what I did so far is I just copied this over here from send to subject attachment. So from is the finance manager, to it is from to Elijah, the CFO. Just copied it from that email. Then send, we send it on the day of the exam. Yeah, if I have a look over here, the CFO sent it at 7 o'clock in the morning. So your time would just have to change. You obviously can't respond at the same time because it's quite a detailed review that you're doing. So an hour later or 2 hours later, whatever you want to do. Okay. Then subject. So we're responding to an email. So therefore, if you go over here, you will see it says subject and then accounting for big branch acquisition. So the exact same thing, other than the fact that we have this thing over here, RE, which means a reply. Okay. So just take note. Then we have the attachment. I kept the attachment the same. So big branch acquisition pro forma journal entries. So okay, I changed a bit accounting for acquisition, whatever, and then FM review. I just made it underscore FM review. Okay, so that's what we did. Then I'm responding saying, "Hi Elijah, I have feedback to your request. I have reviewed the journal entries and I provided commentary. I've also indicated areas where journal entries or further information is required. Please see attached. Please see attached document with all the details." Okay, and then I kind regards finance manager. So then I follow the same format that they have. I have the same format that they have, which is attachment to email and then whatever it is. Okay, so there we go. So now I'm going to go through and answer the question. So now remember, with answering the question, what do we need? We need to review the journals, provide commentary, and then also check for completeness, right? So you will do it in a structure that how you would usually do it. I'm just going to follow a format that I would do in an exam, making sure, or in the real world, basically, making sure I cover all of those responses. So before we go into the specific details of everything, you can kind of give a high-level overview of what's happening, right? So you would say that we have acquired 100% of 100% of the equity of Big Ranch on 1 July 2022. Okay, so we will say that we have acquired 100% of Big Ranch, 100% of the equity of Big Ranch at 1 July 2022. Okay, so that's what we did. Okay, this means we would need to consolidate Big Ranch from 1 July 2022 being the date of acquisition. Okay. So now we can say what does consolidation mean? Okay. Therefore, we will recognize 100% of the assets, liabilities, income, and expenses on a line by line basis. Okay, so that is basically what you would just say. Now we can get into some of the detail. Okay, so what do we know? So we have acquired 100% of Big Ranch on 1 July 2022. So that's why we have to consolidate from 1 July being the acquisition date. Okay, then we're just saying, therefore, we will recognize 100% of the assets, liabilities, income, and expenses on a line by line basis. Okay, so now we can tell them that on 1 July 2022, okay, we have to apply IFRS 3. Okay, so on, let's say the accounting treatment on 1 July 2022, we will apply IFRS 3, okay, business combinations. Okay, so what does it say? So on 1 July, so IFRS 3 business combinations, there's one main principle. Okay, so we'll say the main principle in IFRS 3 is applying the acquisition method. Okay, is applying the acquisition method. Okay, so we were telling them. So the acquisition method. So what we can just say over here is just say high level overview. A high level overview. Okay, so so they understand what we're just trying to say, or background. Okay, so we have acquired 100% of the equity of Big Ranch at 1 July 2022. This means we need to consolidate Big Ranch on 1 July 2022 being the acquisition date. Therefore, we will recognize 100% of the assets, liabilities, income, and expenses on a line-by-line basis. Okay, the accounting treatment on 1 July 2022, we will apply IFRS 3 business combinations. The main principle of IFRS 3 is applying the acquisition method. The acquisition method has four parts. Okay, so one, identify the acquirer, which so we identify the acquirer. Okay, which is Fajr. Okay, so that would be now. Okay, number two, identify or determine the acquisition date, okay, which is 1 July 2022, when we acquired 100% of the equity. Okay, and then number three, what we have to do is determine it is basically to recognize and measure all identifiable assets and liabilities at fair value. Okay, and then lastly, determine goodwill or a bargain purchase gain. Okay, so that is basically what we're just telling them: bargain purchase gain. Okay, so this is kind of just stating IFRS. You're not going to get much, but it's giving them some kind of background. Okay, so now we're gonna have to review. Okay, so we're just getting a high level overview. Okay, what is happening? Okay, so we have acquired 100% of the equity, and so therefore we're consolidating. And then what does that mean? Then we're telling them what at 1 July 2022 what standard we have to apply is IFRS 3, and what IFRS 3 is telling us. Okay, so now what we can do is basically talk about the consideration. Okay, so now we can talk about the consideration. So we can talk about the purchase price basically. Okay, so now we can have some specific commentary. Okay, so what I would have over here, what we can just call this general commentary. Okay. Now we can have some specific commentary. Specific commentary. Okay. So for some specific commentary, now we can say the purchase price. Okay, so I'm going to have here purchase price. Okay. Now we can have the purchase price. So under the purchase price, what we're going to do over here, okay. So for the purchase price, what we're going to say, the cash payment of 14.1 million will be included. Okay, well, what is probably best to state is to start off with a high level principle. Okay, so we will say the consideration will be the fee value. We can just say purchase price will include all consideration transferred to the seller um, at the fair value. Fair value on 1 July 2022. Okay, so that is the general principle. Okay, so now we're telling them that the purchase price will include all considerations transferred to the seller at the fair value on 1 July 2022. Okay, so um, the cash payment of 40 will be included at that amount being the fair value. Okay, the fair value on 1 July 2022. Okay, now we can say the next thing to take note is the the 4.5 million. The 4.5 million is a contingent consideration. Is a contingent consideration. Okay, so the 4.5 million is a contingent consideration as as it is dependent. It is dependent um, on uncertain future events. Okay. Okay. So um, the amount to be included would be the fair value of the 4.5 million rand at 1 July 2022. Okay, so basically we're just telling them it needs to be the fair value um, of the 4.5 million at 1 July 2022. So now we can give them a little bit detail to a little bit we can explain to the CFO a little bit more detail as to how they could potentially calculate it, or we have to seek advice. Okay, so what we have to okay so what we'll have to do is perhaps do the following. Um, um, the fair value could be determined by, um, by calculating probability of achieving the target and then discounting the amount to today. Okay, so that is basically how we could do it, or seek expert advice. Okay, so or we can seek expert advice. So remember, when you to get competence, you're just basically answering all the questions as far as possible. To be higher competent, you give some further insight, further details, as if you are the complete expert. Effectively, that is basically how you would you would get higher competence. Okay, so the purchase price, we'll tell them the cash amount 14.1 will be included. The 4.5 should also be included, but at the fair value of the 4.5 at 1 July. So how could you get the 4.5? So it is basically it's the chance or the probability of achieving that target of 25%. It's by achieving that target of exceeding um, the FY 2022's profit by 25%. So what's the probability of achieving that? Okay, but then that is then we have also discounted to a value of today. Okay, so then if we get, we'll have to pay the 4.5 million. Okay, so that is basically what we would be doing. The next would be the so basically we have covered those two over there. Now we'll have to talk about this 400,000. Okay, so then we will say the legal costs of 400K should not be capitalized to the purchase price. Okay, or cost of investment. Okay, you can say this should be expensed when it is incurred in terms of IFRS 3. Okay, so that is basically what would have to be done. So they should be expensed by who? They should be expensed by FOD-JAN when it is incurred in terms of IFRS 3. Okay, so remember, we can use the word expense, incurred, recognized, because we are dealing with the CFO. We're dealing with the senior accountant. Okay, so the senior accountant has a BCom degree, so you'd understand these terminology, so it's fine. Okay, so that is basically the commentary under the purchase price. Okay, so what was the important ones? The 14.1 million will be included as is. The 4.5 should be included, but it must be based on a fair value at 1 July 2022. The third one, the 400K, that should not be included. I4S 3, I think paragraph 52, 53 tells you do not include it. It must be expensed. Okay, so that is dealing with that aspect. So now we have dealt with these amounts. Now let's deal with the trial balance or the financial position at 1 July 2022. Okay, so now we can deal with financial position. Financial position at 1 July 2022. Okay. Okay, so we're happy with that. Now what we will have to say, so you just give a general principle. Okay. The assets and liabilities on the financial position should be measured at fair value at 1 July 2022. In addition, any other assets need to be identified and and any other assets need to be identified and liabilities to be assumed. Okay, so just take note of that. So meaning, but we will get to that point when they give the further comment, where they give the additional information. Okay, so we're just telling them that the assets and liabilities on the financial position should be measured at the fair value on 1 July 2022, and then any other assets need to be identified and liabilities to be assumed. Okay, so that is basically that. Now we can talk through each of these amounts over here. Okay, so let's go through furniture and equipment, inventories, accounts receivable, prepayments, and so forth. Okay, so I'm going to talk about the cash and cash equivalents. Okay, cash and cash equivalents um, could be recognized as is as as that may as that may be assumed to be at fair value. Okay, then we can talk about uh, furniture, furniture and equipment, furniture and equipment, um, inventories. Okay, we'll talk about that separately. Okay, furniture and equipment. Okay, so because I wanted to group them, but we actually want to talk about different things for each of them. So we might as well show them separately. If you want to say the same commentary to different line items, then you rather group them and say the one commentary as opposed to repeating yourself. Okay, so furniture and equipment should be measured um, at um, at fair value. So we need to determine whether the PPE. I'm just going to put whether the furniture. I'm not going to say whether the furniture. Whether it requires further impairment or whether it requires an impairment, whether it requires not further, let's just say if it requires an impairment or if whether it requires an impairment or adjusted upwards. Okay, if or whether it requires an impairment or requires a fair value adjustment upwards. Okay. Okay, then we say inventories. For inventories, we need to consider whether the fair value exceeds its carrying amount, or whether the fair value is below carrying amount. Okay, for debtors, was it debtors or was it trade receivables? For accounts receivable, for accounts receivable, what do we need to do? So for accounts receivable, we need to determine whether any debtor needs to be impaired, or whether whether the debtor need to be impaired, or any debtors that have been impaired are actually recoverable. Okay, so that is basically what we're going to do. So remember, so just think about it as we want to measure the assets and liabilities at fair value. Okay, so for furniture and equipment, fair value would be if we sell the equipment, can we get the better amount, or have the depreciation methods been in such a way that it's is the equipment so old that it's actually much lower than what it's currently sitting at, or have the depreciation been aggressive, or have the depreciation been too slow, and so forth, right? So if it's new equipment and it's been aggressive, then maybe the fair value, the carrying amount is below fair value. If it's old equipment and the depreciation has been slow, then perhaps the carrying amount is above fair value, so then you have to reduce it. Okay, for inventories, we recognize inventory on IFRS basis from a lower of cost or net realizable value. So at the date of the purchase, we kind of do also like a carrying amount, a net realizable value calculation, right? So that's the fair value calculation. Is the carrying amount above fair value, or is the carrying amount below fair value? Um, so do we need to is the NRV higher, or is the NRV lower, basically? Okay, so then we have to do the necessary adjustment. For accounts receivable, if we take into account, if we look at it from just a pure debtors point of view, debtors is basically gross debtors minus um, what do we call that now? Credit losses, right? So it is um, gross debtors minus expected credit losses, right? So that is basically our debtors number. So we need to make sure that it is at fair value. So is that expected credit? So our gross debtors, is that all our gross debtors? That's the one thing. The second thing would be for that expected credit losses number. Is it overly conservative or is it overly aggressive? Can are some of those people that have been in that impairment category, are they maybe not as severe as what currently recognized? So things of that nature. So that is basically what we would what we basically just stating over there. Okay, so that is important to take note. Okay, so we have covered furniture, inventory, accounts receivable, cash and cash. I mean, you can put prepayments also in the same aspect. I'm not going to go too much detail in prepayments. Okay, so we left with deferred tax and right of use assets. So let's deal with right of use assets and deferred tax. Okay, so right of use assets. Okay, so I'm going to do right of use assets, right of use assets and lease liabilities. Okay, so for right of use asset lease liabilities, um, so in terms of IFRS 3, um, Ojan will recognize, Ojan must recognize leases in which Big Ranch is a lessee as if it is a new lease, okay, by applying IFRS 16. Okay, okay, um, so the right of use asset, the right of use asset will be equal to the lease liability. The lease liability. Okay, so the right of use asset will equal to the lease liability um, plus any adjustment for favorable or unfavorable market conditions. Okay, so that is basically that. Okay, so the right of use asset will be equal to the lease liability plus any adjustment for favorable or unfavorable marketing. We don't know about that. Okay, so I suppose if through the research you'd have determined conditions. So if we think about the lease asset, right? So we were in COVID time, so it would kind of be unfavorable market conditions, right? Actually, it would be probably favorable market conditions for a lessee unfavorable market conditions for a lessor. Okay, so we could state that over here. So we could state from a lessee's perspective, but you just confirm that through research. From a lessee's perspective, the leases may be a little bit more favorable because the lessor wouldn't want to lose out on anything, right? So that is a market condition that would maybe favorable for the lessee. So just take note of that. Okay, I'm not going to mention it over here. So I never researched specifically, but that just comes to my mind. Okay, so you could include that over here that there are favorable market conditions for the lessee given COVID-19. Okay, um, then so for the lease liability will be determined by calculating present value of the lease payments over the remaining lease period. Okay, so that is just basically that. Okay, so that is the lease liability and the right of use asset. You can talk about the discount rate. So the discount rate, okay, the discount rate to be used um, is the discount rate um, implicit um, in the lease at 1 July 2022. Okay, so that's important. Take note over there. So we have covered all of those. We have covered all of that. All we just need to do is over here is um, so we need to do basically the new finance corporation and then deferred tax. Okay, so over here we'll just say the deferred tax will be adjusted for any um, deferred tax on the fair value adjustments listed above. Okay, so that is just basically what we'll do over there. Okay, so just take note. Um, so we just basically went through all the line items over here to actually talk about what would be the fair value. So we spoke about the consideration. So now we went through this IFRS trial balance. Okay, so just take note to tell them that. So why are we applying this? Because at 1 July 2022, we need to apply IFRS 3. The main principle of IFRS 3 is to apply the acquisition method. And one of the points of the acquisition method is to recognize additional information, is to recognize all assets and liabilities at their fair values at the acquisition date. Okay, so that's important. Okay, so now what we're going to do, we're going to work through these additional information. Okay, so the additional information, so we're telling them specific commentary on the purchase price, specific commentary on the financial position, specific commentary on additional information. Okay, additional information. Okay. So that and that. Okay. So I'm just basically making use of so they can figure out what's happening over here. Okay. So point number one. Um, FODGAN must consolidate the the profit, of 210,000 rand, 210K from 1 July to 31 October. Okay, the the profit of the profit of 480, I think, the profit of 420, the profit of 420k will not be consolidated. The profit of 420k will not be consolidated as it is included in retained earnings. In retained earnings at 1 July 2022. Okay, the important aspect over here, important aspect is that we must consolidate the 210k on a line by line basis. Okay, so for example, revenue, cost of sales, other income, other expenses, other expenses, income tax. Okay, etc. Okay, so that is basically what we say we have to consolidate on a line by line basis. They only gave us information at 210,000. Okay, so we would have to work out. So we would have to determine what are the specific items. Okay, so now we're going to have a look at the 650. Okay, so point number two. Sorry. So point number two, the 650,000. The 650,000 is a future cost. Okay, so this amount will not be recognized. Okay, um, the next is I think it was the big one, the customer relationships. The customer relationships may be recognized as an intangible asset. Okay, so the customer relationships may be recognized as an intangible asset. The amount cannot be based on what the board places on it, but but rather but rather what the fair value of those customer relationships are at 1 July 2022. Okay, so we'll have to we can talk later on when we come to the journal entries how we can go about that. Okay, the employees are 1.5 million. Okay, the employee costs of 1.5 million. I mean, what is this now? The workforce value of 1.5 million not be the workforce value of 1.5 million will not be recognized as people cannot be controlled. Therefore, an asset cannot be recognized. Okay. The last part would be that over here. Okay. The last part would be the last part would be the claim of 595 should be recognized as a liability as a liability at 1 July 2022. Should be recognized as a liability at 1 2022 if um, law experts, or what do you call them? Um, law experts in this field um, suggest that the claim is not remote, and is a there, there is a high success, a high chance of the claim being successful. Okay, in that circumstances, in that situation, then the liability would be measured at the fair value of the claim at 1 July 2022. Okay, so that is basically what we would have to state over there. Okay, so that's important to take note. So there's basically the commentary on all of those. I went through a little bit more in detail in a previous video. I'm just writing it out now. Okay, now we're going to come to this aspect, which is one of the most important aspects, which is the journal entries, the review of the journal entries. Okay, so I'm going to put this over here, review of journal entries. Okay, so this here is very, very important. So remember, we have to first give some kind of background. Okay, we have to do some kind of background in order for to explain these journal entries. Okay, so that's very, very important. Um, So what I'm going to do in the next video, I'm going to go through these journal entries, which is going to be a bit long, maybe like 30 minutes. So then we don't have a super long video. Okay, so in the next video, which will probably be about 30 minutes long, will be the review of the journal entries.